If you're retiring coming up, or maybe you're already in retirement, you're probably looking at being a little more conservative with your investments. You're probably not going to want to ride the waves of the market, where the stock market that just rallies up and then has a large pullback. And, when it comes to, if you have $2 million, let's say, in your account, or maybe you've only got 100,000, that's okay. But what I'm trying to explain to you is the movement in the market. Sometimes the more money you have, the harder it is to stomach. And so a lot of people tend to go a lot more conservative when it comes to their retirement portfolios. Now, if you've been conservative here recently, though, you may have realized, man, things aren't adding up and playing out the way I was hoping for. Well, that's all because of something called the federal fund rate. We'll get into it here in a minute. I'm going to teach a lot on really just the conservative portfolio and building that out, understanding what you need to do. But first, let's talk through the federal fund rate. So with the federal fund rate, that's a lot of what's controlling rates right this minute on everything that you're doing. So if you can see here, the line continues to go up from January 2022. It was near zero, and then it went up all the way to 5.5% here recently and has maintained that. And so what has ended up happening is, as the Fed raises rates, your bond portfolios are oftentimes taking a real beating. And I'll explain all of that, or why that is. I'll explain how all of this works to help you to better understand and maybe allocate your portfolio in a proper way. And so looking at this federal fund rate here, this is going to be one of the big drivers, though, of how bonds are, what the credit or the interest rate is on the bonds as well. And so if we're looking at this, the AGG bond fund, or the aggregate bond fund. So what we're looking at is a total bond fund here. This isn't saying, oh, this is just treasuries, just corporates. Total bond fund here has got a big mix in it. And look at the past few years. So you can really tell what's going on here on this chart with a lot of what we were looking at with that federal fund rate. So looking at this as it sits right this second, if you go back to 2020, other than, this little blip here where everything kind of just went crazy for a short second, other than that, what ends up happening is the Fed was cutting rates. As the Fed continued to cut rates, your investments continued to rise. From there, then what ended up happening is the Fed eventually says, hey, you know what, we're going to start raising rates again. Once they started talking about raising rates, it created a lot of concern for the bond market. People started to pull money out of the bond market. So where did money start to go? Well, if you start checking through things, the money market funds right now, we're paying roughly 5%. High yield savings accounts are paying about 5%. There's a good possibility you've got a lot of money sitting in something like that that's not as volatile. It can just sit there and get 5% without having to even worry about it right now. So a lot of people have flocked to things like that. And so you can see here how these bonds have done here recently has not been well at all. And a lot of that is because of the Fed fund rate and the interest rates that come into play there. And so what ends up happening is, in these bond funds, you've got a lot of different options here of what you're looking at. And so you've got the bond funds or the bond mutual funds. Those are a few of your options that you have. Well, with the bond ETFs and the bond mutual funds, what we're seeing here is a basket of a lot of different bonds that come into play that could be traded actively or even passively, but at times they are taking some bonds that maybe have a big loss, and they're selling those off, and then they're buying other bonds with hopes that, hey, they're going to make a little bit of money if the Fed cuts rates. So that's what they're looking at with these bond ETFs and bond mutual funds. And that's why you're looking at this and seeing such volatility in a sense, and as something that, oftentimes has been described as a very, very limited volatility compared to the stock market. And so if we're going here, talking through our bond options, we have the bond ETF and the mutual funds that we were just looking at. And then we have individual bonds. You have corporate bonds, which are obviously, from corporate America. You have treasuries. It doesn't have to be corporate America as well. You can get bond funds that are actually international. You have treasuries, the U.S. Treasury bonds that are out there that the U.S. government is backing and selling there. Then you have municipal bonds. Municipal bonds are different municipalities. Maybe it's a county that's by you that's wanting to build a new road, and they're trying to raise money to do that. And then you have agencies, different types of agencies, oftentimes linked federal agencies that are trying to raise capital as well. So when it comes to these bonds, and what they're doing is you're putting your money up and you're saying, hey, you know what? I've got $100,000. I'm going to loan you by giving you, buying this bond. So you take the $100,000, and then the corporate company or the U.S. Treasuries, whoever it is that's loaning the money or borrowing the money from you, they're going to say, you know what? I'm going to give you 5%. So they're going to give you 5% on your money. It's a little bit like thinking through like a mortgage, but you're the bank on this side of it. And basically you're loaning money out, and then you're going to receive the interest as though just like the bank would be receiving interest. So that's a bit of how this works. And so there's some risks though that come into play. Part of it's just fluctuating price, because bonds are going to fluctuate. And if you have a large basket of bonds and you have a lot of different interest rate changes, the fluctuating price is definitely going to play against you, as we've seen here, unless maybe the Fed is cutting rates and you find some opportunity there. You also have the interest rate risk, just what we talked about. As the Fed raises rates, that is hurting a lot of the bonds that are already out there. I'll break this down a little bit more for you in just a minute, and I'll really start to draw out this and actually show you what I'm talking about there. Then you have default risk or credit risk. Is the company going to go under? So did you loan $100,000 to a company, and now this company says, you know what? We can't pay on this. What are we going to do here? So there's some real risk when it comes to that. Then you've got downgrade risk, so what ends up happening is there's different grades of bonds. So when you're looking at these bonds, if a company comes out and says, hey, we're going to downgrade this bond and now we consider it this type of bond, well, guess what? The value of that bond now may be a lot less at this time. So again, bear with me because this is kind of confusing on how this works. We're going to try to help you and break that down for you in just a minute. And so when it comes to these downgrade risks as well, just not to get ahead of myself on this. So what you're looking at when you're talking about your bonds, you're buying different types of bonds, oftentimes investment grade bonds. So if you're looking at corporate bonds, and sometimes even municipals there, you're going to have investment grade bonds and junk bonds. There's the different grades that are on these bonds that you're looking at. And when you're saying junk bonds, it just means that there's not as high of a credit rating on that. So they're looking at this and they're saying, hey, you know what? There's a little bit more risk that comes into play on these companies of maybe not being able to pay you back your money. Treasuries at this time, there's no really risk there when it comes to that, technically, because it's the U.S. government backing it, though there have been times where the government themselves have been downgraded on bonds, and that definitely can hurt everything going on out there. I think we saw that back in 2008, if I remember properly. So let's talk through this. I'm going to teach this. I'm going to go over to the handy-dandy board here in a minute and actually show you what I'm talking about. So when it comes to the bonds, we'll look here and we'll just go through it real quick. The price, so it's the premium versus the discount there. When you're talking about price, you've got the coupon, which is the interest rate. You have a maturity date. You have a call date. So let's go on over here and let me actually break this down. So let's just take a bond. Let's just say that you're buying bond ABC. Well, the bond price is oftentimes going to be priced out at, let's say, $100 there. So at $100 for this bond. Well, if you're just buying the bond right out the gate, let's just say that it's going to be, it's going to, look here, let's say your coupon rate is 5%. That means they're going to give you 5%. You're going to put the $100 up. They're going to give you the 5%. You're going to have a maturity date here. So let's just say this thing is going to mature in 2030. So in 2030, it's going to mature. They're going to pay 5% annually to you. Oftentimes, the bonds are paying out semi-annually, so you may get 2.5% and then another 2.5%, but it's a 5% annual rate there. Then what you're looking at is your call date. Well, what is a call date? Well, that means that, let's just say this ABC company says that, you know what, we're going to put out this bond until 2030, but what could end up happening is if we get enough money and we're doing well enough, we're going to call this bond on 01/01, let's just say 2028. Well, that means that you'll get to collect the interest that you received, the 5% interest from 01/01 or whenever you got in, let's say 01/01 of 2024 to 2028. But you're not going to get anything over here. You're just going to get your money back, collect the interest you got until here, and that's it. They call it away, or basically they say, hey, we're done with this. We're returning the money to you. You're not having to loan it to us anymore, and we're done with this. So that's kind of the basics of how this is going to work. Now, so let me kind of explain to you, though, when you're in the market and you're in what's called the secondary market on bonds. And so when it comes to the bonds in the secondary market, what ends up happening is let's just say that you have this $100 bond, and let me try to clear this out for us. There we go. Well, a little bit. I'll just leave it right here. Okay, so let's just say you have this $100 bond, and now the Fed comes out and says, you know what? We're going to raise rates. We're going to give out a 6% rate. Well, remember, your bond is 5%. Well, nobody's going to want your bond if they can get a 6%. So what ends up happening is if the Fed raises rates, your bond actually goes down in price because the demand is not as good for it. So maybe it's down to $95. So now there's a calculation you can do. There's a lot of different calculators that you can use for this, but basically you're going to say, okay, well, if I'm selling my bond 95, somebody's going to pay you $95 to be able to take over your bond, and they're only going to get a 5% rate. Well, you can really start to factor in what's it worth to me if I get a $95 bond, but only at a 5% when I could pay $100 and get a 6% rate. So there's a difference there on what's going on. But when your bond price goes down, that means that it's selling at a discount. Now, on the opposite side of this, what happens if the Fed comes out here and they say, hey, we're cutting rates. Now we're going to have a 4% rate. Well, if you have a 4% rate out there, new bonds are going to have a 4% rate. Well, you have a 5% rate. Well, guess what? Your bond is actually going to go up. And let's just say now it's at $105. Well, what's that called? That's called a premium. So that's when your bond is actually going to sell for more than what you paid for it. If you wanted to, you could actually continue to just hold your bond until maturity, and you're still going to get your $100 and you're going to get your 5% on that interest. But if you decided, you know what, I want to get out of my bond, I need some money. Well, if the rates are higher and your bond is less attractive, that means you're going to have to sell your bond at a discount. You're still going to get some money, but just not as much money from it. On the other side, if the bonds are cut and yours is actually higher than what the new bond rate is, well, guess what? You can sell it for a premium and make money off of your bonds. So that's a bit of just a base tutorial on how that works and the understanding of that. And so there's a lot of things and a lot of complexity that comes into owning individual bonds. And that's why you can see that a lot of people just flock to the mutual funds and the ETFs, though with the mutual funds and the ETFs, they're oftentimes going to be a lot more volatile than if you were to just have some individual bonds in your basket yourself. There's a lot of different strategy. This is just some base overview of talking through the conservative style of investing when it comes to your retirement portfolio.